knocked out of the sky before they can get to the targets.
Kirby also confirmed there was another U.S. attack on Houthi targets overnight in Yemen. President Biden has invited House Speaker Mike Johnson, Senate Majority Leader Chuck Schumer, and other congressional leaders to a meeting tomorrow at the White House. As billions in fresh foreign aid stalls on Capitol Hill, Bloomberg government Congress reporter Zach Cohen says keeping the U.S. government running, though, is the top priority.
That'll be another opportunity for the top leaders to get into the same room to try to hammer out maybe a longer-term deal on government spending that could avoid any potential government shutdowns, at least through the end of the current fiscal year, ending September 30th, 2024.
Bloomberg government Zach Cohen. The U.S. Supreme Court is refusing to consider Apple's appeal in an antitrust suit challenging its lucrative App Store. We get more on that from Bloomberg's Karen Moscow.
Both Apple and Fortnite maker Epic Games had asked the court to hear an appeal related to the case. The justices turned down both requests without explanation. The High Court's decision will allow an appeals court ruling to go into effect, letting developers direct iPhone users to cheaper purchasing options outside of Apple's system. The company charges developers a commission of as much as 30% for digital goods and services sold through its App Store. The decision will likely affect billions of dollars in revenue for the iPhone maker. Karen Moscow, Bloomberg Radio.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow, the S&P, NASDAQ 100 index, throwing the Russell 2000 all very much in the red. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks on the pressure from the start today, with the Dow currently down 316 points. S&P's dropped 28, while NASDAQ is lower by 0.4%. The U.S. 10-year yield at 4.06%. Gold is sinking, down 28. Oil trading in the red, but Bitcoin is higher by 1.4%. Among the main 11 S&P sectors, only tech was in the green. Energy and materials were under pressure. And leaders to the upside in the Dow, Disney and Verizon, while Boeing fell 7.8% and led to the downside. In deal news, the JetBlue Spirit deal was blocked on antitrust grounds, and Synopsys to buy Ansys for $390 per share in cash and stock. After earnings, Morgan Stanley fell 5%. Goldman Sachs was little changed. And one bright spot today, NVIDIA hit a fresh new all-time high. Wrapping things up, Interactive Brokers reports after the bell. Live from the first breaking news desk, I'm Bill Maloney.
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type squawk, SQUA on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, well, her firm closed out a more than 2-year short bet against U.S. bonds, with its model signaling that it's starting to become a time to buy as the market emerges from its worst rout in decades. We were talking about the bond market. Time for the Drive to the Close. With us is Katie Kaminsky, Chief Research Strategist, Portfolio Manager at Alpha Simplex Group. They've got $8.2 billion in assets under management. Katie, we are so delighted to have you back, because we feel like you've been talking about what is kind of playing out, not kind of, it's starting to play out in the bond market. Tell us how you see it. And I do wonder if you think the bond market is getting it more right when the U.S. yield curve trades above 4%. Because you were on our air talking about a 6% in the 10-year. What was it, Tim, back in August?
Yeah, we didn't get there, but we did get to 5. We're on our way, I guess. What we're looking for now is a completely different phase. I mean, we saw 9 quarters of short positioning and short views in fixed income, and that has dissipated. And I think the next step is looking for the steepener in the yield curve. And look at today. I mean, wow, like some of those rate cut bets have really come back. And look at where yields are now. You're seeing steepening in the curve right now. The 30-year, 4.3 something.
All right, and I'm going to be honest with you, because Liz Kappa McCormick, she's like a killer when it comes to the bond market. You know her well, and I'm like, Liz, like, because she's been covering, you know, your moves and your thoughts on the market. And she's like, she said, ask her, has the trend following signals gotten more strongly bullish since you discussed them earlier this month? And can you talk about how they look in more detail now? So have they gotten more bullish?
Yes, you are seeing more of a long view. And actually, even when we've looked empirically over different historical periods, it really is the next phase is really for the curve to actually normalize. It feels like we hit the bottom of that particular short trade, and now we're pivoting towards a stabilized yield curve. The question we're asking is, given the wide range of outcomes, what is that steep yield curve? Is that going to be cuts on the short end? Or could it possibly be unexpectedly that we start to see weakness in long-term bonds and we have a longer time to wait for cuts and we actually see a steepening on the long end, something like we're seeing today?
What do you think it's going to be?
And do you still think 6% on the 10-year is possible?
I mean, I think it's always possible. It's going to be a question of how much...
Is it unicorn possible, or is it... I don't know, something more realistic.
But it's like, is it possible in this cycle? Like, are we still in the cycle where you say we could see 6% yields on the 10-year?
I mean, we've already come back to 4.3 on the 30-year, so I think 6 may be a little bit of a ways to go at this point. But I think the difficult scenario would be a situation where we have cuts and it's not doing enough for the economy, and sort of we have weak becomes too weak. Nobody wants to talk about that, but that's the scenario with a wide range of outcomes where you'd have a steeper yield curve where basically long-term debt didn't have as many buyers and we just have too much supply. I think we're far from that right now, but that's always possible, right? I mean, unicorn, I'm not sure, but I always try to think about the range of outcomes. And if we're looking for a steepener, there's the happy steepener, which is everybody wants, which you get cuts in the short term. And then there's the not so happy steepener, which would be, a situation where long-term yields go higher again.
Well, that's what, just to follow, that bet on a steeper U.S. yield curve this year, can that pan out even if the Fed doesn't come through with the about 6 quarter-point cuts that the market has priced in for them doing this year? I mean, the Fed dot plot showed something about half of that, so different. But the trade and what traders are saying is it's going to be a lot more aggressive. So can it come through if the Fed doesn't do those 6 rate cuts?
Well, I think that's the challenge, that people are very, very optimistic, hoping that cuts are going to be coming sooner than later. But if you even listen to the commentary today, I've tended to kind of think that the Fed is taking their time. They would have to see something that would be a catalyst to get them to act. And I don't think that catalyst would be a good catalyst. So from my perspective, it's more likely that we're going to bounce around in what would be, I'm calling a bumpy landing, where we're sort of trying to get there, as opposed to a situation where, everything just goes back really quickly. I think it's going to take time, and I think they're going to be cautious because inflation still is above target. So I think we're in for sort of a bumpy ride to get there, and we're not going to get the cuts perhaps as aggressively unless something more negative occurs, which isn't positive.
How many cuts do you think we'll see this year?
Most people are looking at 4 or 3. I think it's going to depend when they start.
What do you
how
think,
aggressively
though?
they start.
What do you think?
What do I think?
You have to make investment bets. I'm just curious. We're curious kind of what you're betting on.
I mean, I think for us, if you look at what's happening, you're seeing definitely those long signals on the short end and across the curve, which to me is suggesting that the market is really starting to price in more and more from a technical perspective of those cuts. Are they too optimistic in terms of how they're buying and selling? Possibly. But in general, I think there will be a convergence towards somewhere in between. Maybe not as aggressive as people would like, but also not as patient as some might think.
So
if that
I didn't hear
so
four?
I didn't hear
4? Katie?
What's in the middle?
I don't know, maybe 3. I don't know. Yeah, I think it's I think we need to see something start happening first.
I mean, it's not that.
Yeah.
I was going to say that's not that out of this world. I mean, that's kind of what the dot plot showed, is that there are going to be 3 cuts this year. It was that, at the end of last year, investors really started saying, wait a second, Carol, we think we're going to see 6 cuts.
Yeah, it's really interesting. But I will say the market conversations at the end of 2023, we're definitely starting to pull back on that they didn't think it was going to be that aggressive. Because let's remember, if the Fed is going to be that aggressive, folks, Houston, we have a problem. U.S., we have a problem. Hey, the dollar, it's up about 1% this year. I'm just looking at the dollar index. Do you still see a very short signal on the U.S. dollar, despite it doing well?
Actually, the dollar, the short signal really was gaining a lot of momentum towards the end of the year, but I'm not surprised that we're seeing some respite there because we saw so much selling of the dollar in the end of the quarter. And also, as you see pressure on equities, that tends to be very favorable for the U.S. dollar.
Yeah.
And if the Fed is actually not going to be as aggressive in cuttings, that's also favorable for the dollar. So there's a lot of stuff moving towards that long dollar signal, but it's still kind of mixed from our side, given just how noisy we've seen it.
Hey, really quick, 10 seconds.
Recently.
What's a key thing that you watch really quickly?
Oh, I'm watching bond volatility. It's still way high. and bond stock correlation. Those
All
two
right.
things are the things that are different.
You're a gem.
right now.
So much fun. Katie Kaminsky over at Alpha Simplex Group. Thank you so much. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. The World Economic Forum underway in Davos. Bloomberg Radio is there. We've been speaking with top CEOs across a swath of industries. And this morning we caught up with Moderna CEO Stefan Bancel.
I didn't get my COVID shot because I'm scared of being hospitalized. You know, I'm 52, I'm pretty healthy. But what I don't want to have is long COVID. I had co-workers who got long COVID, and it's really, really bad. And those were healthy people in their mid-40s that spent 6 months without being able to be a father or a mother, a co-worker. And these are the type of things we need to prevent.
And Moderna shares, they are down now by 3.7%. By the way, you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. A federal judge in Boston has ruled that JetBlue cannot complete its $3.8 billion acquisition of Spirit Airlines. District Judge William Young sided with the federal government, ruling that the deal would stifle competition and raise fares for consumers. Shares of Spirit are are plunging now. They are down 47.1%. JetBlue is trading higher. JetBlue up now by about 4.6%. The owner of Burger King Restaurant Brands International plans to buy its largest American franchisee for about $1 billion in cash in a bid to fast-track an overhaul of hundreds of locations and win back customers. Restaurant Brands, by the way, also owns Tim Hortons and Popeyes. And those are some of our top company stories at this hour. And this is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, just about 4.5 minutes left in today's trading session, getting ready to wrap up. Yep, it's Tuesday, in case you forgot that we had a long weekend.
I have been forgetting.
Tomorrow's already Wednesday.
My wife forgot because,
Did she?
Yeah, because she was, snowing this morning, and she was like, oh, I was like, you should work from home today. And she's like, oh, well, Monday's the day we all have to be in the office. And I'm like, it's Tuesday.
Honey.
And she said,
Stay home.
No, she went to work.
Aw,
yeah.
You're good. Ah, good soldier.
Yeah. She's got to lead a meeting.
She does. Oh, well, that'll make you
She's got to go to work.
All right, we got to go to work because we're getting ready. Go to work. Yeah, we're here. I'm happy to be here.
Wasn't that bad of a commute?
It was really sweet. I shoveled a little bit this morning.
Yeah, same.
It's kind of good.
Okay.
All right. Speaking of getting to work, we are getting ready to wrap up the Tuesday trade. Shortened holiday week, as you know. Interesting day where we just talked with Katie Kaminsky and just talked about yields moving up. Having said that, Davos is underway in Davos, Switzerland. World Economic Forum, and confidence in the resilience of the global economy is cheering up the Davos crowd against a backdrop of war and prospective political upheaval in the year ahead. So the Davos elite, basically glass half full on the global economy.
Us worry?
Everything is awesome.
Yeah, okay. So hours after Donald Trump's Iowa caucus win raised the likelihood of him clinching the U.S. presidency again and possibly shaking up the world order too, attendees in the Swiss resort spent Tuesday putting a brave face on the outlook.
Yeah, it's interesting. A lot of soft landing talk, right?
Yeah, from the IMF officials and central bankers emphasizing the probability of a soft landing to financiers and business leaders observing the solidity of the backdrop. A gathering that began shrouded in gloom for 2024 is now featuring moments of cheer.
Yeah, it's interesting. Deutsche Bank's CFO telling our Francine Lacroix, it's a bit of a pinch me moment that we've been going through. The resilience of not just the economies, but also financial markets to the geopolitical crises that are going on, to the rise in interest rates and the fight against inflation has been remarkably strong. Many would argue there's a lot coming at us, and yet there does seem a level of stability. Having said that, Katie Kaminsky is finding it interesting, the volatility that she's seeing in the U.S. Treasury trade.
That's true. And back to Davos, Gita Gopinath over at the IMF saying, quote, we feel like a soft landing scenario. The probabilities have gone up quite a bit because we've had inflation come down without needing that much of a loss in terms of economic activity.
All right, so some optimism. Glass half full.
Glass half full.
It's only 16 days in, though, folks.
And, maybe when you're in the Swiss mountains, it feels nice.
Remember where we were at January 16th last year. All right, time for Beyond the Bell. Starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting it down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with Carol Masser and Tim Stenevec. Welcome to our audiences across our Bloomberg platforms. That includes television, radio originals, and our partnership with those folks streaming on YouTube. Stocks on the back foot in a big way here right now, Carol, with 10 of the 11 S&P sectors deep in the red.
Yeah, and if you're a member of the KBW Bank Index, you're probably even down more than we are seeing in the major equity averages. That index is down about 1.4%. If you're Morgan Stanley, you're down more than 4%. So we know big bank earnings continued today, and that is certainly one of the underperformers, that area today.
Yeah, we talked to Katie Kaminsky over at Alpha Simplex Group. I know you guys spoke to her a couple weeks ago, and she mentioned that change in tone that we're seeing and referenced Fed Governor Chris Waller's comments earlier today. And she says, the market is pricing in too many rate cuts this year. She thinks there's going to be 3 or 4, and she's kind of leaning toward 3 rate cuts and says something bad is going to happen if you're going to would have to happen in order to see more rate cuts than that.
Yeah, it's the same old story when it comes to the Fed speak, yet markets seem disappointed disappointed each time any kind of Fed official says maybe not 6 rate cuts. What's interesting here, Romaine, is volume has picked up today. It's about at least 10% higher than the 20-day average on a day where it feels like we're just kind of meandering.
Yeah, it'd be interesting. Well, everyone's back at their desk for one, or at least at their desk somewhere, depending if you got snowed in. But it raises the question, too. I mean, we really are headed into the heart of, I guess, what can be called catalysts for the market, whether it's earnings season. Remember, we get some big economic data next week here when it comes to looking at fourth quarter GDP. And then you move in towards the end of the month, and, of course, you get the Fed and that next meeting. We are getting the closing bells here in New York, pretty much right across the screen, no matter where you look. So let's walk through the numbers really quickly here. The Dow Jones Industrial Average lower by about 230 points, down about 0.6%. The S&P is going to close lower by about 18 points, or about 0.4%. And we should point out that it's now testing to the downside one of its key short-term moving averages. The NASDAQ Composite down about 0.2%. We should point out the NASDAQ 100 almost finished the day in the green, but it's going to finish the day unchanged. But the big laggard on the day, you can find that in the mid caps and the small caps. The Russell 2000 RTY down 1.2%.
All right, and definitely more of a negative tone in the trade overall. If I look at the S&P 500, you've got 362 names, Scarlett, to the downside, 137 actually gaining some ground today for unchanged.
All right, let's take a look at the sector performers here. We'll start with the laggards, the ones that are leading the market down overall. You have energy off by 2.4%, with all 23 big cap energy stocks lower. Consumer durable and apparel down 1.8%. Capital goods also losing more than 1%. On the flip side, your outperformers include semiconductor companies, NVIDIA and AMD, as well as telecom names, Verizon, and autos and components up 0.4%.
All right, guys, let's get to some of the individual gainers in the Tuesday trade. And atop the list, in fact, number one in the S&P 500 and the NASDAQ 100 is AMD, Advanced Micro Devices, finishing the day just off its highs, 8.3% to the upside, rallying the highest, to its highest, I should say, since November of 2021. So in quite some time, over more than 2 years. Barclays raising its price target on the stock to 200 from 120, seeing AI as a primary driver of growth, saying the growth will be driven by multiple customers across hyperscale and enterprise. Barclays continuing saying, while NVIDIA has a lead in AI, Barclays thinks the desire to have a second source will overwhelm difficulties for the software ecosystem. I thought that was kind of interesting. Barclays has an overweight rating. Susquehanna Financial also raising its target on AMD to 170 from 130. They've got a positive rating. AMD closing just shy of $159 a share. I'm going to stay with chips for a moment because we did have a deal in the chip space. Chip design company Synopsys agreeing to buy software develop Ansys for about $34 billion. It was a cash and stock deal. It's one of the largest deals announced worldwide so far in the past 12 months. So kind of interesting play. Synopsys, I thought, was interesting. It was up more than 3%. The company that it acquired, actually, we saw some selling in that name. Which
I thought that was weird too, right?
Right?
Yeah.
I don't know. Maybe they just, I don't know. Maybe they didn't think they didn't pay enough. I don't know.
Yeah.
Anyway, all right. Getting away from the chip space, if I may, JetBlue, an outperformer at its highs today, guys, almost a 12% gain, finishing with about a 5% gain. We know what it's about. Basically, JetBlue getting a dose of, hey, investors, tell me how you really feel about my plans to buy Spirit Airlines. Basically, a federal judge in Boston blocking JetBlue's
Is there anyone who liked that deal? Because apparently the judge hates the deal, regulators hate the deal, investors hate the deal, and the CEO who brokered that deal is on his way out.
Yeah,
so.
He liked it.
Yeah. It's
always
kind of wild.
A weird cultural fit between those two companies. I don't know if they would have clashed. Hey, speaking of that, my top decliner, Spirit Airlines, down 47%, finishing the day at $7.92. It fell as much as 1.61%, the biggest intraday decline on record. This after that federal judge blocked JetBlue's acquisition of the company, saying that the combination would stifle competition and raise fares for consumers. And speaking of air travel, let's check in on shares of Boeing, the worst performer on a percentage basis today in the S&P 500, down 7.9%, sinking yet again after falling more than 12% just last week. Shares extending their sell-off so far this year after we heard from Ryanair Holdings CEO Michael O'Leary, one of the biggest customers for the 737 MAX, who said that there's a risk that there will be further delivery delays that Boeing management will get distracted in Seattle, or there will be new processes or something. This Michael O'Leary said in an interview regarding the 737 MAX 9 that is continuing to be grounded. Down 23% so far this year.
I know, that's pretty remarkable.
It's remarkable. I mean, lost nearly a quarter of its value just in half a month. And then shares of Apple, the worst performer on a points basis in the S&P 500 today. Apple shares fell after the Supreme Court here in the U.S. refused to consider Apple's appeal in an antitrust suit challenging its App Store. We've been covering this one for years, guys. It's a decision that will likely affect billions of dollars in revenue for Apple. In-app spending is forecast to reach $182 billion this year and $207 billion in 2025. And if Apple can't continue to get that 30% cut, if there are other app stores that where this stuff becomes where consumers can get this stuff, then Apple could take a hit.
And I'll just add another one there. We should point out Morgan Stanley did end the day down at 4% here. Worst day for that company going back over the last 3 months. And in fact, you go back 3 months ago, the last worst day that they had was actually on an earnings day as well, back in October, mid-October, when those shares dropped about 7% on the back of earnings. Let's check in on what happened in the yield space here, because we did see significant activity there as people resumed the sell-off in the bond market. And of course, that was directly tied to some of the comments that we heard out of Christopher Waller, the idea here that if you're betting on a drop in rates, don't expect to get that anytime soon. He's saying the Fed funds rate should stay elevated, and you see that reflected in the price action in the spot market with your 10-year yield up 13 basis points here, your shorter-term 2-year yield up by about 8 basis points on the day. The entire curve, guys, shifting higher.
Yeah, the entire curve shifting higher. The U.S. dollar also shifting higher as well. Stronger by a wide margin. The biggest rally in about 10 months on Chris Waller's comments. It raises all kinds of issues about how other central banks around the world start to move next as well.
I got to tell you, I'm a little surprised we didn't see more of an equity market reaction to the Fed governor's comments here. I mean, if you go back to the beginning of the year, we're pretty much flat on the S&P 500, and that was when rate expectations were, investors were so much more confident that there would be, 5-6 rate cuts this year. And since then, we've just heard so much pushback, but we haven't seen equity markets match what we've seen in the bond market.
I think what's interesting, too, is I think the equity markets are trying to figure it out. Okay, wait, so if the Fed doesn't need to be as aggressive with rate cuts, maybe that means the economy is actually doing okay and can kind of get through that, soft landing, kind of Goldilocks scenario. But at the same time, doesn't want them to stay too high, right? Because you bring it down a little bit and then more of a risk trade could be on. People are willing to take some risks, if you will. So I think there's kind of this tug within the markets right now.
Well, yeah, and I would
certainly on the equity side.
Yeah, absolutely. And we talk about a market that was pretty confident they were going to get basically the equivalent of about 6 rate cuts prior to those Waller comments. They did pare back those bets, but they're still pricing in a much higher probability here that we'll still get about 5 to 6 rate cuts. So, I mean, we basically go from a firm 6 to kind of 5 to 6. Yeah. So I guess expectations did temper here. But just to address your point, Tim, too, I think you have to see a little bit more movement in those yields for it to really start to rattle equity investors.
And I should say that I was talking the S&P 500, not what's happening with the Russell 2000, because that's certainly been a different story, Scarlett.
What'll be interesting is what happens at the FOMC meeting at the end of this month, because Fed officials are likely to start talking about slowing, not ending quantitative tightening, which would have the effect of providing some easing to the overall economy as well. And not to say that they're going to do anything on it right away, but just that discussion will start leading people to place their bets.
Yeah, and one other thing I would say on the equity side of thing, I know we have to wrap, but the other, we've had quite a run up, and we've seen, 52-week highs taken out in a lot of different sectors and individual names. And I think for an equity investor, you got to be like, okay, is all the good news and the expectations factored in, or will earnings ultimately show us that there's more room to run? So I think it's just this kind of tug of war, pull, I guess, or something like that.
Wait and see.
I don't know. Yeah, wait and see. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, guys. It's Tuesday. We're done. We'll see you again tomorrow for Beyond the Bell at 4 p.m. Wall Street time. A little bit, gathering at the World Economic Forum's annual meeting in Davos. The theme this year, rebuilding trust, with the question for leaders attending the event, will the coming year be a period of perma-crisis, or will 2024 be a time for resolution, resilience, and recovering? Based on what we just talked about, glasses half full, they're feeling pretty good right now.
Enter today's big take, and one of the most read stories on the Bloomberg terminal. It's not about all of the talk of a soft landing and rate cuts that will support growth in markets around the world. Instead, Carol, it's the pessimist guide to the global economic risks this year. This piece, by the way, a collaboration between Bloomberg News and Bloomberg Economics.
All right, so let's get to it with Ben Holland, Global Economics Editor at Bloomberg News. He joins us on Zoom from Washington, D.C. Ben, thank you so much for being with us. Tim and I have been spending a lot of time already here, 16 days into 2024, talking about risks, and some of them feel pretty rough. Tell us about the collaboration, how you guys put this all together. Let's just start there.
Yeah, we started from the point that the pessimists have tended to get things right in recent years, and so obviously after a few years in which we've had, starting with the pandemic, it was pretty clear to see all the things that could go wrong, and I think where we started was the two major conflicts that are still unfolding in 2024 with no evident end in sight, and most of all the Middle East, which is dominating our headlines every day. I think that was kind of the starting point for global risks this year.
Yeah, I think a lot of people, certainly if you would go back a year, did not see that coming. And at this point, we are, more than 100 days into Israel's and the Israeli-Gaza war. But the threat is not just within that region, Ben. It's a threat that really concerns a wider, more global involvement of this war.
Yeah, so I think whenever you talk about a conflict in the Middle East, the vector by which people think that that's likely to affect the world economy, or that could, in a worst case, affect the world economy, is of course via energy prices. And we haven't really seen that as you say, in 100 days of the conflict in Gaza so far. But the risk that oil markets have been worried about, of course, was that the conflict could escalate. And I think it's hard to say after 100 days, even though it perhaps in fact did not escalate in the way that people feared, it's hard to say that the risk has gotten any less. And when we look at what's been happening in the Red Sea in the last week or so, you could actually easily argue that it's got more. And not only that, but in addition to the biggest risk of all Middle East conflicts, which is an effect on the world economy via oil prices, you now have a very clear risk of some kind of effect via shipping prices also, because we are seeing disruption to a very important trade route, and it's not really clear that anybody can do a whole lot about it.
Yeah, it certainly feels like, every day we see the headlines, we talk about the Red Sea, we talk about, those giant ships, pausing or taking a longer route, a more costly route, but it does feel like as attacks seem to escalate, dare I say it, it does feel like we're just kind of waiting to see, does it go truly the escalation route, or does folks somehow, global leaders say, okay, we got to stop this before it just, takes off and running. And we really are kind of in a third world war, if you will, even though some might say that we already are there. Hey, I want to go to the Fed because we just talked about it with our TV colleagues. The Fed getting it wrong. It does feel like the markets are kind of pulling back from expectations of an aggressive Fed sometimes. And we keep getting warnings from Fed speakers. The Fed could get this wrong, or could they?
The Fed and any central bank can always get it wrong, of course, yeah. So what we found interesting when we were looking at the risks from the point of view of central bank policy, particularly was the comparison between the US and Europe, I think, where obviously in both cases you've had very substantial interest rate increases, the kind of policy that should slow down the economy. And in neither case has it really led to the kind of drastic slowdown that you might have expected if you plugged in quite that big interest rate hike into the models. And we kind of felt that there were two different risks going on in the US versus Europe. And in the US, it seemed that maybe a bigger risk was that just the thing didn't work, It didn't slow down the economy all that much. It might actually start heating up again in ways that the Fed doesn't like. And of course, what we talked about with the Middle East conflict, adding to shipping costs or energy costs, that could play into that too. And so you might have a risk that the Fed that thinks it's done realizes at some point in 24 that maybe it isn't done. Whereas in Europe, you seem to have kind of the opposite risk, which was a central bank that's done a lot, the economy slowed down, but did not come to a kind of juddering halt. But what if it's all still in the pipeline? The famous long and variable lags of monetary policy. What if in Europe that stuff is still yet to bite in a big way? That is what could lead to a sharper slowdown in Europe in 24.
Hey, Ben, in the piece, you guys mentioned this natural language processing model that captures Fed speaker sentiment. This is cool. What does it show, and how does this work?
Well, it's a kind of linguistic analysis of what Fed people are saying, quite literally, with a weighting attached to various words that they use. It's based on news reports, but based on thousands of news stories that come out with direct comments from Fed speakers, and it's an attempt to gauge, if you could literally measure their words to see how they're, whether they're tilting in a hawkish or dovish direction, based on the use of certain keywords, certain kind of phrases that come into play. What would it tell you? And what it tells you, I think, is pretty clear in the chart in the story, which is that, yes, they pivoted, but the pivot has a long way to go before it actually gets into the area of, we're about to cut rates.
All right, let's get to also one of the largest economies out there, and we're talking about China. 2023, we all thought, okay, that's going to be the year China comes roaring back. It did not. You guys note it still looks a little bit wobbly.
Yeah, the risk of the long-running real estate crisis there, which, of course, in other countries like Japan in the 90s and the United States in 2008, I think it's on everyone's mind that the real estate crunch can lead to a deeper financial crisis. Hasn't happened in China, and what you've had is a disappointing rebound, but the risks this year, we think, are kind of tilted to the downside in China, and the starting point is not great anyway.
So we don't have time, Ben, to get to everything on the list here, but I want to give you the choice to go where you want to go, and what our audience watching and listening right now needs to know about the year ahead.
Well, a couple of, to try and end on a bright note here, since in the piece we basically focused on the things that can go wrong, and obviously there's a lot that can go wrong. It was kind of interesting to look at a couple of economies where you feel like, most things that could go wrong already have gone wrong, which is Turkey and Argentina. And both of them are still facing very, very severe challenges. But just the possibility that those countries might turn a corner, there's been a long time in coming. Argentina, still their inflation rate is above 200%, and there is a substantial risk that it kind of takes off even from there. But after a radical change of policy and with some support from the IMF, it does seem possible that they could turn the corner this year. And Turkey has also done a kind of U-turn away from its very unorthodox policies. It looks now like things might be stabilizing there. So let's highlight those as the kind of the things that might go right.
Final thoughts, 20 seconds. Risks are risks, right? They may not play out, and we need to remember that, right?
That would be the best good outcome, I think, is if none of the bad outcomes happen. Yeah, stuff.
Yeah, the guys are or the individuals in Davos right now are saying the glass is half full. They're seeing a lot of resilience despite this list of risks.
It's cocktail hour there. That's why. The glass is half full. Okay?
Well said. Ben, thank you so much. We really appreciate it. Ben Holland, Global Economics Editor at Bloomberg News, on Zoom from Washington, D.C.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg with the Dow, the S&P, and NASDAQ in the red. Wall Street pared its bets on Fed rate cuts, on speculation. The dovish bid emboldening stock and bond bulls has gone too far. 10-year yield 4.05% with a 2-year at 4.22%. The S&P today lower by 17 points, down by about 0.4%. Dow Industrials down 231 points, a decline of 0.6%. NASDAQ, the composite index, down 28 points, a drop there of 0.2%. While the NASDAQ 100 index, a little change today, down less than 0.1%. 10-year yield, as I mentioned, 4.05% with that 2-year at 4.22%. Gold, 2027 the ounce, down 1.4%, while West Texas Intermediate crude was down 1.2%, 71.83 a barrel. Boeing shares extended their 2024 route after analysts and a key customer, Ryanair, voiced concerns that scrutiny of the plane maker's manufacturing since a January 5th near disaster with a 737 MAX 9 could lead to a slowdown in aircraft deliveries. Also, analysts at Wells Fargo cut their rating on Boeing to equal weight from overweight. Boeing today dropped 7.9%. Again, recapping, stocks lower, S&P down 17, drop there of 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. There's a lot going on in the chip space today. First up, and I talked about this, we talked about this earlier with our TV colleagues. Chip design company Synopsys agreeing to buy software developer Ansys for about $34 billion in a cash and stock deal, marking one of the largest deals announced worldwide in the past year. I just want to point out that Ansys shares were down 5.5% today. Synopsys was up 3%.
Yeah, maybe because the deal for Ansys came in below prior reported levels. That's according to some analysts who we spoke to here at Bloomberg News. Secondly, Carol, Advanced Micro Devices, AMD shares rallying, outperforming the stocks big time. The chip maker trading at its highest in more than 2 years as Barclays raised its price target on the stock to $200 from $120, seeing AI as a primary driver of growth.
Basically saying it's not just about NVIDIA because maybe they can't do it all. I do want to point out
AMD's pretty happy about that.
AMD, number one gainer in the S&P 500 and the NASDAQ 100. All right, so let's get into it with Bloomberg News managing editor of technology and global cybersecurity here at Bloomberg News is Lynn Dewan. She's here in our Bloomberg Interactive Broker studio. A lot going on. Let's first talk about the deal. These are not companies that I feel like when we talk about semis, do we typically talk about these two companies? Tell us about them and what we need to know.
No, nobody knows about these companies outside of these walls.
Okay,
We're the
I'm
experts.
so glad you, can I just say I'm so glad you said that?
We're like,
because
who? What?
I'm like, okay, this is a $34 billion deal. And yes, there have been mumblings about this over the past week or so.
Yeah.
And I was like, I should know about these companies. This is a big deal.
Synopsys was up 61% last year, by the way.
That's right. It's a good gainer. I mean, there's good reason, right? So Synopsys owns this very specialized part of the chip supply chain, which, as you know, is critical to the world. Chips are in everything. They're in televisions, they're in refrigerators, they're in cars, they're in like AI, compute, and Synopsys doesn't make the chips. Synopsys doesn't even make the chip machines that make the chips. Synopsys makes the software that flows into the machines that then makes the chips. And there are very few companies that are in that space. So they already have a really good market share in there. And this investment, this $34 billion deal, what that does is it increases their stack, so to speak, in the technology world. So they're not just designing the software that makes the chips, but they're able to now integrate this company, Ansys, that builds models that allows manufacturers of everything from cars to like aircrafts, defense devices, and military equipment to model how that equipment is going to be used in the real world. So imagine taking this like chip design company and merging it with this modeling software, and you have like a very powerful combination that can go after even bigger market share.
Kind of a one-stop shopping, it feels like.
That's right.
Companies.
Yeah.
You need your chips, Carol. You know where to go, right?
Yeah, we do.
You do all your chip shopping there.
Yeah, last time I went chip shopping. But it's wild. It's funny. I love the supply chain analysis function on the Bloomberg. And Ansys, I mean, customers are Caterpillar, Boeing, Rolls-Royce, Lenovo, Huawei.
The military.
Like all of them, right? And then I'm looking at Synopsys, and I'm looking at a lot of companies that I don't actually know.
Oh, well, you just mentioned AMD. AMD, right?
ARM.
All the
That's true.
major chip manufacturers of the world are going to use a company
Intel.
like Intel. That's right.
And Ansys is
I'm
actually
going down
a
the list
customer.
now. I see them.
Ansys
Okay.
is a customer.
They have a
of Synopsys.
years-long relationship with each other. What they would say, and I think they said it during their call earlier this morning when they announced the deal, is that this is like years in the making. Like they have been using each other's technology for quite some time.
Regulatory problems, regulatory issues.
Right.
Because
So
it was
we mentioned-
interesting. Synopsys
yeah.
rallied, which
Yeah.
was the acquirer, which is not what you typically see, and then Ansys as the target went down.
Both moves are counterintuitive.
Yeah.
To some extent, exactly what you mentioned, which is the fact that like the price it's going for is less than what the market had expected. There were some reports, not from us, there were some reports out there about the fact that Ansys could end up going for like $400 per share, and it ended up going below that. So that's one reason, but another reason is exactly what you said.
Stock closed at
The
327 and change today. That's a big bump.
Yeah.
Okay.
So another reason, of course, is the regulatory concern over having these two companies merge together. That's a pretty powerful market force, and whether it gets past the CFTC and other regulatory agencies, we don't know. And then there's the geopolitical pressure of China, right? Will China, a big consumer who has a say in these kinds of mergers, even if they're two American companies, sign off on a deal like this that would create a powerful company within here, within these bounds?
That's surprising to me.
Yeah.
Why would
Yeah.
China have a say here?
It's super surprising. I didn't learn this until like another deal that involved two other technology companies ended up falling apart earlier this year. China is a major consumer of all things around the world. Because it has huge buying power, it actually has say and influence and approval processes in place for mergers of companies that serve the country.
That's interesting.
Even if they're outside of the country.
So I did the FAGO function on the Bloomberg terminal,
Yeah.
literally FAGO. And what you can do is you can pull up the financial analysis by geography, and you can see that, in fact, for Synopsys at least, 15.2% of the company's revenue in 2023, the fiscal year ended in October, came from China.
That's exactly right. And actually, in an interview with Bloomberg Television not too long ago, Synopsys even said that the then outgoing CEO of Synopsys said, we would be selling even more to China. China would represent an even larger share of our market if it weren't for the restrictions that the U.S. has placed on exports of chip technology and chips themselves to that country.
And it doesn't look like Ansys gets a significant portion of revenue from China at this point. It's not
But
even
it will.
considered.
Yeah, right.
Good
So
point.
once it's a part of the company.
I mean,
Exactly.
for Synopsys, it opens up a ton of different markets for them, right, that they haven't already played in. So, I don't know, net, how are you thinking about this? Is this likely to happen, or we're going to have to be patient, or I don't know. How do you think about it as an analyst? I know you can't say yes or no in terms of it's going to happen, but
so
I don't
hard
know.
to call whether it's actually going to happen, but I'll point you to two things. One, there was a very large merger in aviation today that faced some antitrust pushback.
JetBlue
That
and
call a few
Spirit.
hours ago.
JetBlue's
potential acquisition of
right,
Spirit,
right.
yeah.
But on top of that, I will also point you to
Because
the
it was
estimated.
they were concerned about anti-competitive. Would this be anti-competitive?
That's the question,
Okay.
right? And they raised that as like a potential concern as part of their conversation today with investors. But the other thing I'll point you to is the estimated closing date of this deal is the first half of 2025. In the market's mind, that just points to the fact that they are anticipating a potential fight.
You never want a deal to take a year to close. I mean, even from selling a condo, somewhere in the U.S., a realtor is going to say to you, "Let's get this thing closed as soon as possible because the longer we wait, the more this deal can fall apart."
Raising my hand.
Yeah.
We do have a election here in November.
Are you raising your hand because you want to talk, Carol?
Well, yeah.
Okay.
Is it the expectation that
about that election,
we'll get
yeah.
through an election, we'll have a new administration? Is that part of it?
That's an interesting strategy. I hadn't even thought about it. Will we be ushering in a different CFTC that is more like merger friendly? I don't know. It's not like the Trump administration was.
Both of them have been
Right?
pushing in terms of
Exactly.
China, but you never know, right?
Yeah, that's a dangerous game to play if that's the reason why they're scheduling the closing for first half of 2025.
I don't know. It's just weird. It's a long time. Quickly, can we move?
Yeah, go ahead.
Can I talk?
You can talk. Yeah. Permission granted.
I'm giving you permission.
AMD, number one gainer in the S&P 500, the NASDAQ 100. I loved what Barclays had to say, and part of it was, I lost all my notes, but basically, NVIDIA, yep, it's been the chip company we talk about when we think about AI, but basically saying maybe they can't do all of it, like the ecosystem that AI is creating, that you're going to need more players.
Why are you
maybe
shaking
AMD.
your head?
It was always a crazy phenomenon to me that only NVIDIA would enjoy an AI bump. It was so
Love
crazy
that.
because we would throw all these other chip companies out there like, hey, remember AMD? Remember, all of these other companies that also, and for some reason NVIDIA was just eating up all that. I mean, they have first mover advantage, but first mover advantage only takes you so far. At some point, others crowd that area and you have to figure out how to continually innovate. And you just had AMD come out with this new NVIDIA chip rival.
Right.
Like it was only a matter of time before everyone woke up to that. I'm just a little surprised that it took that
Barclays
long.
said the desire to have a second source will overwhelm difficulties for the software ecosystem. Is there anybody else, in addition to AMD, that you think we should be watching in terms of the chip
As
space?
in, is there any money that should pile into any other potential
I
stuff?
know you can't tell
I won't
people,
touch it. I
but,
won't touch
but
it.
should that we have on our radar?
Maxim is another, chips company that comes up every once in a while. I will leave it there because I don't want anybody to end up trading on my stock advice. But there are others in the space, and frankly, ARM is a publicly listed company right now. They marketed their IPO on the hopes of an AI bump. So there's another one that could be a potential play.
Our producer is right. We have to have you on. That was great. Thank you so much. Bloomberg News Managing Editor of Technology and Global Security, Lynn Dewan. Thank you so much, Lynn.
Hey, you hear that music? You know it's time for Check the Latest World and National News. We got Nancy Lyons in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Ukrainian President Volodymyr Zelensky says Vladimir Putin is a predator. He told an audience of global finance and political leaders aid to Ukraine is worth the investment. He was speaking at the Economic Forum in Davos.
Putin is frank about what he wants, what he does, and who his targets are. His answer to the duration of the war is always war, without an end, and he wants in this way.
President Biden will be meeting with congressional leaders tomorrow to promote his supplemental aid package to Ukraine. French President Emmanuel Macron announced that missiles and bombs for Ukraine will be going from France. He says we cannot let Russia win. Donald Trump is back in court today as jurors were selected for his defamation trial in the E. Jean Carroll case. Palm Beach County DA Dave Ehrenberg tells Bloomberg Trump has already been found to have committed the assault.
We're just talking about damages. How many millions in compensatory and possible punitive damages will be assessed? So the only reason why Trump is there, I think, is to try to gain political points.
Dave Ehrenberg spoke with Bloomberg Sound On. Prosecutors in Suffolk County, New York, say they've analyzed new DNA evidence linking the suspected Gilgo Beach serial killer to a fourth murder. Rex Heuermann pleaded not guilty in court today. Suffolk County DA Raymond Tierney says the high-tech analysis of hairs led to the new charges.
Nuclear DNA existed in the hair since they were first recovered in 2010. And now the science has caught up. I would say that's a good break for justice, a good break for the investigation.
Global news 24 hours a day. I'm Nancy.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg with the Dow, the S&P, NASDAQ 100 index, Russell 2000 all finishing the day in the red. S&P today lower by 17 points, a decline of 0.2%. Dow Jones Industrial Average down 231. We did finish off session lows, but still a decline today of 0.6%. NASDAQ was down 28, drop there of 0.2%. 10-year yield 4.05% with a 2-year yielding 4.22%. Spot gold down $28 the ounce. That was a drop of 1.4%. Gold at $20.27, while West Texas Intermediate crude retreated by 1%, $71.94 a barrel. Wall Street paired its bets on Fed rate cuts on speculation. The dovish bid emboldening stock and bond bulls has gone too far. Katie Kaminsky is with Alpha Simplex. She's chief research strategist there. She was a guest today on Bloomberg Business Week.
The Fed is taking their time. They would have to see something that would be a catalyst to get them to act, and I don't think that catalyst would be a good catalyst. So from my perspective, it's more likely that we're going to bounce around in what would be, I'm calling a bumpy landing, where we're sort of trying to get there, as opposed to a situation where, everything just goes back really quickly. I think it's going to take time, and I think they're going to be cautious.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Goldman Sachs reported profit that topped estimates. Goldman Sachs shares did gain today on a down day for the rest of the market, up by 0.7%. Also reporting earnings this morning was Morgan Stanley. Its wealth business surged past expectations, even as traders fell short again, dragging down profits at the firm. Today, Morgan Stanley was lower by 4.2%. Recapping, stocks declined. S&P today down 17 points. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, airline stocks falling for yet another day. This after they got absolutely hammered on Friday. Back then, Carol, the S&P gauge of airlines declined the most in 19 months. United fell more than 10%. Delta fell 9%. American Airlines fell 9.5%. This all a result of Delta lowering its profit forecast for the full year, which really underscores the challenges the broader industry faces when it comes back to recapturing that pre-pandemic performance.
Yeah, like you said, the group overall down 7.6% on Friday, down another 1.3% in today's session. All right, so concern lingers even after what was the busiest day ever for U.S. air travel just a few months ago. We're talking about the Sunday after Thanksgiving. So, all right, what's going on?
Yeah, Haley Berg is back with us. She's lead economist for the travel app Hopper. That app analyzes trillions of data points, i.e. prices, on flights, car rentals, and hotels to make predictions about how much tickets are going to cost. Haley joins us on Zoom from Boston. Haley, good to have you back with us. So what gives here? Because Hopper says that more than 3/4 of Americans are going to spend the same or even more on travel this coming year. So why are we hearing the gloominess when it comes to airlines?
One of the biggest sticking points for prices in the last 3 or 4 years has been supply. There have not been enough seats to book, and that's why fares have been so incredibly high over the past few years. Think back to summer 2022, domestic airfare, the highest that we had seen in all of our history at Hopper. So supply is now exceeding where it was in 2019. A lot of it is exceeding now on international routes. So part of this is just the equation of travelers are looking for low prices. There are more seats available to book, so they have more options. A lot of those options are low-cost carriers who may have entered or expanded in the last 2 years. All of that is putting downward pressure on prices, despite the fact that 50% of our users at Hopper are expecting to travel more this year than they did last year.
Is that true domestic versus international travel?
Yes, we're seeing a tremendous amount of demand for international travel, especially among younger travelers. And they're not just hitting the London and Paris of the world. They're really going to more off the beaten track destinations. destinations where there might be deals or just more unique experiences. So still very strong demand on international. Capacity there has been slower to recover. Prices to Europe are recovering because we've seen capacity added back there. Prices trans-Pacific, very different story. They still remain 30 to 60% higher because capacity has been slow to recover there.
What about when it comes to other parts of the travel experience, hotels? I couldn't believe how expensive hotels were in the fall when Carol and I were traveling, and we weren't even staying. We weren't even staying in nice hotels, and I was, what?
What hotel?
One of the.
Remain nameless.
Yeah, it was not nice, but it was so. I couldn't believe how expensive it was. What's it going to look like this year?
You're not alone in feeling like accommodation prices have been incredibly high. They have been. And we're expecting them to stay about the same this year. If we do see improvement, it would probably be towards summer or the second half of the year. But yes, demand for travel remains high, and that means that hotel stays, vacation rentals, especially in those peak markets, they're selling out. And that means that if you're not booking far enough in advance, you're probably seeing incredibly high prices. What we always recommend is for hotels in particular, if you're headed to a big city, book at the last minute. That's when those perishable rooms are going to go on sale. If you're headed to a leisure destination, you're going to Miami, you're doing a spring break trip, book that very far in advance, couple months, because that's when prices will be lowest, when that availability is still high.
What are you looking at, Carol?
No, I'm just kind of, I'm thinking.
What are you thinking?
No, it's just interesting. And I just wonder, what you're seeing. We've got a great chart for our folks who are watching on YouTube and our streaming service. I'm just not sure. So it says, if you're thinking about the main vacation plan you want to take in 2024, and this comes courtesy of our Bloomberg Intelligence team, if the cost exceeds your planned budget, what will you do? 12% are going to look for a cheaper destination. 15% are going to look, I guess, at attractions and maybe what they're spending there. 45% will increase their budget. So almost half.
And if you're just listening to us and not watching, the 45% is the possible changes if your budget exceeds plan. The majority of people, almost the majority of people, almost half the people said they'll just increase their budget.
Yeah.
I mean, that's bullish.
But it's bullish. But it's also interesting when we just did a story about where if people found that they had a 10% bump in income or something.
Yeah, they pay down debt.
They're going to pay down debt. So help me. Are you talking about, I don't know, what are you seeing? Higher end traveler, bigger pocketbook, lower end? Is there any differences?
There are a few things happening. So our Hopper users are primarily Millennial and Gen Z, and 77% of them say that they are going to spend the same or more on travel this year. And there's really two schools here. One is our millennial generation. They've built wealth. They are coming out, many of them, of a few years of savings, those who were in advantageous positions headed into the pandemic. They are spending more on travel. A larger proportion of their wealth is going towards trips, vacations. They have credit cards that allow them to gain points. The more they book, they are loyal. So this group is absolutely spending more and traveling more. And then on the flip side, we have incredibly price-conscious travelers, more on the Gen Z end. And what they're doing is they're taking their travel budget and they're saying, can I get 2 trips out of my budget from last year that might have been 1 trip? And we often see this. Travelers are skipping the trip to Miami and they're going to a destination in Puerto Rico that might be a whole lot less expensive, both flight and in-country expenses. So there is some optimization within the budget that's absolutely happening. We see that a lot among Hopper users because they're very price sensitive.
Okay, very briefly, we have top domestic and top international locations. Your top domestic locations, we got a list of them we're about to show on the screen. Which one sticks out to you of these 5 here?
I would say that Orlando is always a big one. It's popular not just for those Disney trips, but also for Port of Orlando, starting on cruises, which, as we know, are coming back, in the last year or two. So Orlando's always a big one, in part because no matter how much demand we see going there, prices are low. It's an accessible and affordable place to visit.
And international, your top international locations: Cancun, Mexico, Dominican Republic, London, England, Rome, Italy, Tokyo, Japan. That's kind of a mixed bag. Just got about 15 seconds left. Any thoughts on that?
Those tropical destinations are inexpensive alternatives to some of those longer haul trips, but really this year is going to be all about Tokyo and the return to Asia.
Wow. That's cool to hear.
That's interesting. Where are you going?
Me?
Yeah.
We don't have anything planned. Oh, I'll probably go to the American West.
Oh, that's what you said that earlier. All right, Haley Berg, lead economist at Hopper. Thank you so much. That was fun. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Shell has halted oil tanker transits through the Red Sea as Houthi militants retaliate against American and UK airstrikes in Yemen since Friday. The U.S. Navy has advised vessels to stay away from the southern Red Sea, effectively closing off the Suez Canal. For those who follow the guidance today, we had ADRs of Shell down by 3.2%. The World Economic Forum is underway in Davos, where Bloomberg Radio caught up with Chevron CEO Mike Wirth, and he spoke about maritime tensions in the Red Sea region.
These are risks we deal with all the time. Last year we had a couple of ships attacked by the Iranian Navy. Actually, one of them was boarded and hijacked into an Iranian port. So this is a part of our business that we deal with. We take it very seriously. The safety of our people is the most important thing, and the risks in that part of the world are very dynamic and volatile right now.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcast. Chevron shares today declined 2.4%. A federal judge in Boston has ruled that JetBlue Airways cannot complete its $3.8 billion acquisition of Spirit Airlines. U.S. District Judge William Young sided with the federal government, ruling that the deal would stifle competition and raise fares for consumers. Today we had JetBlue shares gain 4.9%. Spirit, though, plunged by 47.1%. Those are our top company stories at this hour, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
It is Bloomberg Business Week. Tim Stenovec and Carol Masser live in the Bloomberg Interactive Brokers studio in New York. Let's get to Washington, D.C. now for a check on latest world and national news with Nancy Lyons in the 99.1 Newsroom. Hey, Nance.
Hey, Tim. President Biden will be holding a White House meeting tomorrow with congressional leaders in hopes of convincing them to approve his supplemental aid package for Ukraine, Israel, and Taiwan. Republicans insist they want changes at the U.S. border as part of any deal. White House Press Secretary Karine Jean-Pierre.
Congress should act. They should act quickly. This is about the securing our border. This is about our national security, and the consequences of congressional inaction would be severe.
Ukrainian President Volodymyr Zelensky appealed to financial leaders attending the Davos summit today to invest in rebuilding his country, and France says it will be sending new bombs and missiles. Winter weather continues to cause headaches at airports all across the country today. So far, over 33,000 flights within, into, or out of the U.S. have been canceled. More than 7,000 have been delayed. Among the airports heavily impacted, Chicago O'Hare, Reagan National, Houston Bush, and New York LaGuardia. The architect charged in a string of murders known as the Gilgo Beach killings is now being accused of a fourth death. Authorities say Rex Heuermann has been formally charged with the death of a Connecticut woman who was the mother of two whose remains were found along a coastal highway in New York. Heuermann pleaded not guilty in court today. Well, you can add a new name to the list of EGOTs. Those are entertainers who won an Emmy, a Grammy, an Oscar, and a Tony. The new name? Yep, Sir Elton John. He won an Emmy last night to earn EGOT status, the 19th entertainer on the list. It was for Elton John Live, Farewell from Dodger Stadium, that aired on Disney+. Other winners last night, in case you missed it, were Succession, that won Best Drama, and multiple other nods, along with Bear, that also won several awards, including Best Comedy. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. Now back to you, Tim and Carol.
Thank you so much for that update, Nancy Lyons. Carol, you know what I like to do? I like to type in READ GO on the Bloomberg terminal.
Me too.
The most read stories. You can change it by hour. And one of the most read stories in the last hour is a story about New York City and how the mayor, Eric Adams here, has actually reversed many of his previously announced cuts to services, including police hiring and trash collection, in the budget that he unveiled on Tuesday that's going to run about $109.4 billion.
It's a lot of money. Yeah. The reason the mayor said was nearly $3 billion in extra tax revenue. Look what we found.
Where did that come from?
Oh my God. Where is that
Do you
hiding?
ever? I have a question for you.
He also
Do you
said-
ever misplace $3.7 billion? Like you put on a jacket, you don't, it's the end of the season, you put a jacket in the closet, and then you reach into your pocket and there's $3.7 billion in there.
That's a lot. Extra tax revenue. He did also say a reduction in the estimated cost of caring for tens of thousands of migrants. We're having some fun, but it seems like a lot of money to kind of like misplace.
It does. We should note
it's forecasting, though, I guess, a little bit in terms of how the economy plays out. So maybe the estimates
and how much things are going to cost.
Yeah, exactly.
We should note that you've probably heard, if you live in New York City or if you live in the tri-state area, some other budget cuts that the city was facing. There were 5% cuts to most city agencies, so including the elimination